Good afternoon, Axia members, and welcome. This is Brannigan, and this is the weekly profiling and footprint stream. Now, what is good is we're actually going to do a little bit more of a profiling stream today. Obviously, if you've been a member for a long time, we do focus quite heavily on the footprint. The reason being because the footprint is quite a sexy new thing. It's a new tool that's sort of hit the market over the last 2 years, and it's something that we get a lot of demand for, a lot of questions for it. So there's a lot of content for me to talk about day after day. Now, what's good about this stream? Obviously, this is our objectives. This is what we're going to focus on, and today's stream comes from a question. So it's best to start today's stream with this picture in mind, and then I'm going to bring up the question. So I'm just going to move across to the question we got for the week, which was this. It was in the profiling course. So obviously Axia's got a market profiling edge course. So it says in the course that was developed in 2016, the IB, which stands for initial balance, the initial balance for the German DAX was 7 to 8 a.m. The question was, has this changed because of the change of Eurex's hours, and how does this impact the strategy? Okay, so for those of you that have taken the market profiling course, you'll be well aware that one of the 10 strategies taught within the course is the initial balance. Okay, whether that's the wide initial balance or the initial balance, or the narrow initial balance. That strategy is taught, within the market profiling course. Now, fantastic question, and I'm going to use this stream to hopefully answer, your question, but also give you a little bit of an understanding of how the initial balance came about, what it represents. Okay, and the best way to do it is to start off with this graphic. Okay, so what you're looking at here is 5 days of market profile session. So each one of these little blocks represents an entire day of trading. Okay, now the way you got to think about it is as a distribution. Simply, all that's happening is we've got the price on the right side, and every one of these letters is ultimately representing time. Okay. Now, I'm not going to go through the basics of market profiling, but what I do want to just bring to your attention is market profiling has been around for over 30 years. Okay, so if you think it's a relatively new tool or a new way to plot data, it isn't. Okay, obviously candlesticks have been around a lot longer than the market profiles. But all the market profiles it's nothing other than a different graphic depiction of data. That's all our charts are, whether it's candlesticks, whether it's profiles, whether it's footprints, whether it's curves, they all one and the same thing. They're all taking data points, i.e. time, i.e. price, i.e. volume, i.e. volatility. They're taking all these data points and just graphically depicting them in a way that we can make an understanding of it. And that's really, really key. If there's one takeaway from the stream, that is it. Okay, don't be confused as to thinking the charts represent anything other than a graphic depiction. Okay, the charts do not give you the answers. The charts simply just give you a little bit of a painting of the picture. It gives you a deeper understanding of what the data is trying to tell you. Okay, from there, you've got to interpret that data accordingly and make trading decisions on that. All right. Now this will become a little bit more clear. I'm gonna show you this in a really good example, as we go through the stream. And at the end of the stream, you're going to go, oh wow, actually I'd never thought of a trading principle as simple as an initial balance actually having so much power. Okay, that's what it comes down to. You will not become a millionaire trading the initial balance. I promise you won't. Okay, I'm not a millionaire, and I've been trading the initial balance for 20 years. Okay, but what you will become trading the initial balance is you will become a lot more observant with regards to what the market is trying to do. In other words, when there is a narrow IB, that's telling you something about the market. It's giving you an understanding as to the characteristic of the market at that point in time. Okay. Now, where it becomes powerful, In fact, I'm skipping ahead. But where it does become powerful ultimately is when you get the confluence lining up. You've all heard of the confluence, okay, or the stars lining up, all right? So when the confluence lines up, for example, when you have a narrow IB that coincides around a big breakout point, so a big resistance point or a big support point, all right, those initial IBs tend to be very good breakout opportunities. Not because Brannigan says so, but because that is what the backtest results show. Okay. Conversely, when we have wide initial balance, playing for breakout strategies is a very low probability trade. Why? Because the market has already exhibited extreme volatility. Okay, and that's the key. It's the confluence. It's, can I combine the IB, whether that's narrow, whether that's wide, can I combine that with another strategy, because it's adding an extra layer of power to that strategy. Okay, now what you're looking at here, like I said, is 5 days. Now where I want to sort of bring your attention to, now again, please, I say this to all of the members and anyone that's taken the course. You never need to copy the way I do things. Okay, that's not going to help you. What you do need to do is you need to understand why I do things the way I do. Okay, so you see these little pretty blue lines. Right? All that pretty blue line is it's showing me the initial balance period. Okay. So we can see that's the initial balance period, that's the initial balance period. Now, I tend to make it a little bit thicker because I want to be aware of that period. In other words, everything I have on a chart, okay, I don't just have this orange here for fun. I have the orange there because orange represents volume to me. Okay, the same with the red. Right? I've always used red as a point of control. So I don't need to think, right? I cross-pollinate this across my candlesticks. You'll always know where my point of control is on any chart I have because it'll always be red. Okay, so there's logic to what I'm seeing. All right, and that's another important takeaway. Too many traders want too many things. Keep it clean. Keep it simple. Whatever's on this chart must mean something of significance. It must add value. Otherwise, it's distracting you. Okay, anyways. Now, what I want you to look at is compare the sizes, okay, of the blue line there, the blue line there, and the blue line there, and there, and there. Okay. Now, all of you will obviously say that, you know, this one in the middle tends to have the widest blue line. Okay, or the widest initial balance. Okay, and that's all it is. That's all we're looking at when we talk about narrow IBs and wide IBs. We're looking for relatively large IBs compared to the average and relatively small IBs like we've got here compared to the average. Okay, so roughly speaking, remember, it's an average. In other words, over time the average changes. So as volatility increases, we'll see the IB average increase and counter. Okay, so that's how we identify whether an IB is wide or narrow. We simply look at it relative to the average at that point in time. Okay, now this is the set of questions I have to answer, because this is the, you know, if I can answer these questions, then all of the members and the gentleman that asked me the question will fully understand, you know, the answer to his question. So that's the initial balance explained. Okay, it's just simply a range of prices over which we trade in a specific time period. Okay, now I'm going to explain this with an example so it makes 100% sense. Okay, so the initial balance traditionally, right, this has been around a long time. Okay, so take everything I say and cast your mind back 30 years, because people have been talking about this and working out strategies on the initial balance for many, many years. Right? But the initial balance was always the period, okay, of trading that excluded the cash market. So it excluded the influential players. Okay? Basic example. If I'm trading in the Asian session at 2 a.m. in the morning UK time, right? Goldman Sachs sitting in London is not there. Okay? Neither are any of the big banks, neither are any of the big hedge funds, neither are any of the big pension funds. Okay? The influential players, the guys that need to do 10, 20, 30, 40, 50,000 contracts. Okay, so that period, that time period that excludes those large time frame participants is the initial balance. Okay, and that's important to understand, because a lot of people are going to push back and go and say, no, the initial balance is from 11 p.m. to 5 a.m. Okay, now you're not altogether wrong, but listen to what I said to you. I don't want to give you an exact time for the initial balance. I want to give you an exact understanding for the initial balance. So the understanding, the principle of initial balance, is the time period in which there is no influential participants. Okay? Now for some markets it's pretty straightforward, and I'm going to give you the initial balances that I use, okay? But I am going to put a caveat to it. So we'll go with the standard S&P 500. All right. Now we all know the S&P opens 2:30 GMT, UK time. Okay, I'm in the UK. So the GMT, the S&P opens 2:30 GMT, which means when it opens at 11 p.m. at night, okay, until 2:30, in theory, okay, this is the initial balance. So this is the traditional initial balance you will hear people talking about. However, as the markets have evolved, okay, some people would argue that, well, no, actually, the initial balance period is from 11 p.m. to, for example, 8 a.m., i.e. when Europe opens. Okay, that would also be regarded as fine. Okay, so this is technically, theoretically correct. Why? Because obviously at 2:30 p.m. the cash market opens and the big players come in, and we see that with the change in volume. Right? But if you told me, well, with the correlation in the markets nowadays, if something were to happen, there are big time frame participants that are still trading the S&P in the European session, I'd say, fair enough if that's your IB session. There's logic to that. Okay, and this is where the caveat comes. It doesn't matter what period you use for the initial balance period, so long as there's justification, in other words, there's logic behind the time you're using, i.e. example 2. But secondly, so long as you keep it, maintain it, don't change it, don't switch. Okay, if you choose 11 p.m. to 8 a.m. because there's logic behind it, stay with that. Develop the strategy of that. Develop the understanding around that. Okay, don't change. And that's the key crux of it. There is no exact IB time. And I get this question all the time. Can you tell me what the IB times are for Eurex or for CME products or for gold or for oil? Or, okay, it all depends, guys. It all depends. All right. So I'm going to give you the classic ones so that you've got them. But I'm going to touch that caveat. All right. Now, your FX markets, again, it depends. But from 11 p.m. at night to roughly 7 a.m. in the morning, you've got the Asian session, the quiet session. Okay, from 7 a.m., you tend to get the cash participants stepping in. Okay, so that would be for FX. For oil and gold, okay, what time does the oil pits open? Around 2 p.m. in the afternoon. Okay, so from 2 p.m. to 11 p.m. to 2 p.m. would be for your CL. However, here's the caveat. Remember, CL is very highly correlated to Brent. Okay, Brent trades in the European session very heavily, whereas WTI CL trades very heavily in the US session. So again, it all depends. If you told me, actually, oil from 11 p.m. to 8 a.m. is a better IB, I'd say excellent. Okay, I'm not going to disagree with you because there's logic behind it and you're sticking to that being your IB. Okay. Sorry about that. So hopefully that now makes sense to you in terms of the times chosen for the IB. It all depends. It's not an exact science. But once you pick an IB, stick to it. Okay. So that's how you select your time. That's the principle of the IB. Okay. Now, it's important to note the reason we use the initial balance is to ultimately develop a strategic understanding. Okay. So what do I mean by that? I'm going to go back to the example. The basic understanding. I'm not going to go through the full strategy. I'm not going to show you the execution. That's not the purpose of this. Okay, if you want to learn about profiles, that's why there's an edge course. Okay, I just want to give you an understanding so you can go away and observe this. I want you to actually go and look at it, and I'm going to show it to you on the charts. So what we're going to do now is we're going to look at two examples, one from the 5th of Feb and one from the 13th of Feb. Okay, both very recent, both wide IBs, and I'm going to show you the basic understanding. However, as a principle, as a basic concept, when we have wide initial balances, you have to be extremely cautious at looking for breakouts to the upside and looking for offers to the downside. Okay, why? Because the market has already exhibited a large amount of volatility. Okay, so it's almost like if a market is used to moving, say, one standard deviation, if a market's used to moving the mean every day of, say, 10 handles, if all of a sudden in the overnight session without cash players we move 20 handles, which is maybe one or two standard deviations, we move 20 handles, the probability is that the market is going to spend the rest of the session within that range, okay, within that predefined range already. Okay, that's the basic understanding. On the flip side, when we have very narrow IBs, okay, the probability of a breakout and extension is very, very high. Okay, so wide IBs, we don't want to be aggressively buying high and selling low. If anything, we want to buy low and sell high. On narrow IBs, it's the other way around. We want to be aggressive at the extremes. We want to sell lows and buy highs, looking for that extension of the range. Okay, very, very basic rule of thumb. Very, very basic. Okay, it's not just a case of you put your buy order there and you put your sell order. Right. Now, think about that for a second. Okay. Imagine you come in one morning, it's 2:30, you've done your profiling analysis, you see it's a wide IB on the day, you see, for example, that the market is stuck in a big sideways range, and all of a sudden the market gives you this wide IB and you really have this good support level that you want to buy. The confluence of the two, knowing it's a wide IB and having a really good support level, that's what gives you the power. Okay, that's where the real edge starts to develop. Okay, now again, that's an oversimplified way of looking at it, but that's the crux of why we use market profiles. Okay, now let's go to the example. Let's get the chart up, and we can then go from there. So what you're looking at here is the 5th of Feb. Okay, and I'm going to open this up for you. I'm going to split the session for you. So what I'm going to do is I'm going to show you the IB session, and next to it I'm going to show you the cash session. Okay, so this is our IB session. We can see the market spent the entire morning inside a 10 handle range, doing nothing. All of a sudden something comes out and the market bids up. Okay, this was a wide IB day. All right, now this is the cash session. So what I want to do is I want to show you what the cash looked like. Okay, so we can see, let me remove that. Okay, I'm going to have to split this out so you can see it. Okay, so you want to follow from this B print. The B print is the start of the cash. This is 2:30 in the afternoon now. Okay, so we can see the first thing the cash market does is offer a little bit. Okay, and straight away we can see it bid up and offer. So there's a lot of two-way trade. So the market is trying to find the buyers lower down. It's trying to just fill in a little bit of this, sort of overnight session. All right. The important takeaway, and you will see this extensively in wide IB days. All right, we talk about overlap a lot in profiles. So a very basic example of what overlap means. If you look at these TPOs, which are these letters, there's very little overlap in price. In other words, the market is exhibiting very nice trending or momentum type characteristics. Whereas if you look at these prints, they're almost fully overlapping each other. Okay, and you will see in wide IB days, you'll see an extensive amount of overlap, whereas in narrow IBs, you'll see far less overlap and more directional movement. Okay, so what we see for almost this entire cash session, I mean, this is 1 hour, 2 hour, 3 hour, 4 hour, for 5 hours. Okay, the market just sits drifting around in a 14-15 handle range. Okay, so what I said, we look to sell the highs, we don't look to buy the highs. So we sell the open. Market comes down. Okay, remember, we don't want to be aggressively buying highs or selling lows. We want to buy low and sell high. Okay, market then comes up again, extends the overnight high, but what does it extend it by? Okay, it extends it by 30 all the way up to 35. So it extends it by 5 handles. Okay, and then the market just dies off and pretty much closes at the high of the session. All right, and that's the key for these wide IB days. It's not just, we talk a lot about, when we talk about strategic development, it's not just about knowing what to do, but it's also about knowing what not to do. Okay, if I see a wide IB day, I'm not necessarily just going to sell the high. Okay, that's a blind, random shot. What I am going to make sure I don't do is I am going to make sure I'm not aggressively buying the highs and aggressively selling the lows. Okay, so learning to trade is about as much as learning, where you can make money, but more importantly, learning, when to avoid putting yourself in difficult situations. And that's what the IBs teach you. They teach you to avoid difficult situations. Okay, that's the first example. Let's move on now to the 13th of Feb. So we can see 13th of Feb, that's this day, yeah? Okay, if I open that up again note, market offers a nice little grind overnight. And all of a sudden, what do we see when the B print comes in? Okay, B and C, complete overlap. D, okay, a little bit of a bid up, but then we start to see E, F, G, H, and I completely overlapping. Okay, notice where the market fails. Market fails at the high of the day, starts to drift back in, and eventually goes bid up. Okay, so again, it's not just a case of we randomly sell it and we make money. All right, if it was that easy, we'd all be millionaires. Right? But we don't want to do is we don't want to be aggressively buying this high okay, or aggressively selling this low. Not because Brannigan says so, but because that's what the back testing results show us. Okay, now I'm going to show you one more little example of a narrow IB. So I'm going to show you on the other side of the equation what it looks like. Okay, so this is from the 19th now. 19th of Feb, which is last week, and what we can see is a very narrow range, unusually narrow range. Okay, so we can see the market was almost stuck inside a 10-handle range for the entire morning session. Okay, cash market opens. What does it do straight away? But up, takes out that initial balance high. Okay, C print comes back, and we start to see a little bit of trend direction in the market. Okay, so a nice little trend direction. So if I open that up, you can see a lot of sort of two-way trade in the morning. Cash market opens, breaks through the high, and we extend upon that range in a more trend-like fashion. Okay, so again, in narrow IBs, we don't want to be fading the extremes. Okay, what we want to look for is look for momentum at those extremes and go with the flow for an extension of the range. Okay, all right, guys, that's then the initial balance. There's not much more to it. That's how it works. Now, what I will just leave you with is that profilings are wonderful, okay? Market profiles are a great way to depict information, okay? They give you a very good contextual understanding of what the market is likely to do on any given day, okay? It's a very principle-based course. In other words, it's not going to teach you a rules-based approach, all right? If you're looking for a rules-based approach in trading, you're looking for the wrong thing, okay? Because guess what? Principles will never change, okay? The principle in anything never changes. It'll always remain the same. Rules will always need to be changed. Why? Because market participants adjust the strategies or adjust their approach to the strategies as the markets evolve. Okay, so learn that for a lesson. If people are trying to get you to, take on their rules-based approach, just remember that those rules might work for a while, but after a while, they'll need to be adjusted. Right? And that's why we believe in teaching a principle-based approach. I'll teach you the IB, whether it's narrow or wide. I'll teach you the understanding of it, why it occurs, how it occurs, but then more importantly, what it means. Okay, what it means for your trading. Okay, not if you see it, go sell the high and buy the low. No, that rules-based approach it's too fixed, and those rules adjust too easily over time. Okay. All right, guys, thanks for that then, and thanks for the great question. If you do have any questions for next week's stream, there's my email address. Otherwise, yeah, if I had now to solve a problem, I'd spend 55 minutes thinking about the problem and 5 minutes solving the problem. So Albert Einstein. All right, guys, thanks, and we'll catch up again next week.